Do you own bonds in your portfolio? Should you own bonds in your portfolio? As people approach retirement, they are looking for ways to create income. Traditional view is to buy a bond and CD that creates income. Is that the right move today? Show's called Your Money, Your Wealth. Joe Anderson here. I'm a certified financial planner, president of Pure Financial Advisors. And today we have a special show. Big Al's on vacation, so we have Bond Man Brian. Welcome to the show, Brian.
Oh, I am dying to make some sort of cool James Bond joke, but I don't have any.
We got Brian Perry. He's our Executive Vice President, Director of Research. He was a bond manager in a previous life. So we're going to break things down. Should you invest in bonds in a zero interest rate environment? All right, let's walk down history lane. Interest rates, 10-year. So back in 1945, 1.7%. Remember the 80s, right? Your house mortgage, 15%, but you could also purchase a CD for 16%. Could you imagine getting 16% on your money right now with a CD? Now you look today, it's almost zero, 1.6%. What does this really mean? So if I look here, 1998, if I look at the 10-year Treasury, that's the safest investment almost in history, was 4.5% in 1998. Today, it's 1.6. So let's say you have $1 million that you can invest. That's your nest egg, and you don't want to take any risk. So what do? You buy the Treasury. Back in 1998, guess what? You received about $46,000 on that safe investment. Today, with that same $1 million, you're getting $16,000. This is the issue. People are retiring. They want to protect their money, but can you live on $16,000? The answer's probably no. The problem is even worse. Half of you don't even know what I'm talking about right now because we're talking about bonds and people are like, what the heck is a bond? So let's bring in Bond Man Brian to break things down.
Yeah, thanks, Joe. And you're right. You know, I've been doing this a long time, and in my experience, the majority of people don't understand bonds, right? They may understand stocks or on CNBC. Bonds are a foreign concept. And so what we want to do today, cover a few things to leave our viewers better educated, starting with bond basics. Like you said, what the heck is a bond, right? And then importantly, once you understand what a bond is, why should you invest in it? Interest rates are low. Should you invest in bonds, right? And if you want higher returns, how do you do that in the bond market? And as a last resort, if you don't want bonds but you still want income, how do you stretch and get maybe even more income? Those are the things we want to dive a little deeper on today.
You know, when you look at it, Brian, it's crazy to imagine just a few years ago you could get, almost $50,000 in one of the safest investments. And now you have to build a pretty diversified portfolio to get that. So let's dive in and talk about what is a bond. Let's just kind of start real simply. How does it work?
Yeah, I mean, at the end of the day, a bond is a loan, right? Stocks are ownership in a company. You own a part of that. A bond is simply a loan. You're lending somebody money. Maybe you're lending the U.S. government money. That's a treasury bond. Maybe you're lending a local city, the state of California, the state of Texas, the city of New York money. That's a municipal bond. Maybe you're lending a company like Microsoft or Oracle money. That's a corporate bond, right? So you're simply lending money. And in general, the way that a bond works is that you lend the money for some period of time. Maybe it's 5 years, 10 years, with the agreement that you're going to get that money back at the end of the time. And along the way, in return for that, you get interest. You get coupon payments generally every 6 months. And so let's say you lend somebody $100,000. Your hope is that at the end of time, you get that $100,000 back. And along the way, maybe you get a few bucks in interest. But like you talked about, that level of interest has come down quite a bit. But here's the one issue is, what if you don't get your money back, right? And so you have to consider how safe is the person or entity you're lending the money to.
Why do corporations issue bonds?
Well, they need the money to fund their operations, right? Maybe they want to run a new factory. Maybe they want to try a new product launch. They need the money. They can sell stock and raise money that way, but it's giving up a share of their future profits. When they issue a bond, there's no share of their profits. They're not giving away ownership in their company. They're simply borrowing the money with the agreement to pay it back. But you want to be careful, right? Because if you lend money to, let's say, Apple, that's probably pretty safe. If it's a tech startup in the garage, it's a lot less safe. So you need to look deeply into that.
Looking at municipal bonds, treasury bonds, why does the federal government issue bonds?
Well, the federal government issues bonds to fund what they're doing. So the federal government on a day-to-day basis runs a big deficit. It's trillions of dollars at this point. In order to fund that, they issue Treasury bonds. That's what they use to operate. It's considered the safest investment in the world. The problem is there's not much return there because it's so safe.
You know, when people look at bonds, they kind of consider them the same. It's like, well, bonds are safe. But then you have junk bonds. Remember the good old junk bonds? What the heck is a junk bond?
Yeah, so a junk bond's nothing more than a bond issued by a lower credit quality. So like I talked about where maybe Apple is really safe, that tech startup in the garage not as safe. So if you lent money to that tech startup, it might be considered a junk bond, right? So why the heck would you do that? You do that because you get more return. And so it's like everything that we talk about, it's risk and return. You might have the chance to get more interest, but you're gonna have to take on more risk, more possibility that you don't get your money back.
You know, here's the problem is that when people look at bonds or bond mutual funds, they might be looking at past performance, right? So when you pick your mutual funds in your 401k plan, you know, you have Fund A and Fund B, and Fund A had a 10-year return of 14%, and Fund B had a 10-year return of 3%. What do you think most of you would select? Of course you would select Fund A because that did 14%, and of course it's going to do 14%, you know, in the future. But you have to look at the risk. You have to have risk, right, to create that overall return. So looking at this matrix in regards to bonds, right, again, you're not buying profits in the organization. They're just lending you cash and they're charging you an interest rate. So if I want really safe money, okay, well, I want to go short on my loan. I only want to lend Brian that $100,000 for 30 days, right? Not necessarily 30 years. So the shorter the term, right, the safer you are, but the lower the interest rate. The longer you lend that money out, of course, right, you're going to be taking on risk. So when you look at, let's say, corporate bonds, okay, you're probably sitting here. If you're looking at treasury bonds, you know, you're probably sitting way over here. On the biggest side could be the junk bond, where I'm lending my money to a lower grade company that could be on the verge of default, where they need cash. So you give them a loan for a long time, you should get compensated for that. The problem that we see is that you're looking at returns and not necessarily understanding the overall risk. Okay, that's enough of the technical bond talk for a lifetime. Go to our website. Our special gift is why bonds in a zero interest rate environment. It's our bond guide. Go to yourmoneyyourwealth.com. Click on Your Money, Your Wealth. Special offer this week. If you fell asleep here, just wait till you read that guide. yourmoneyyourwealth.com. Click on that special offer. We'll be right back. Hey, welcome back to the show, folks. Show's called Your Money, Your Wealth. Joe Anderson here with bond man Brian Perry. He's a CFA, Executive Vice President of Peer Financial Advisors, to break things down. We got a lot more bond talk, but let's see how you did on the true-false question.
Yeah, today's true-false. When you buy municipal bonds from a state you don't live in, you don't have to pay taxes on the earnings. And remember, the whole reason for buying municipal bonds is that they are, generally speaking, tax-free. The true answer on this question, though, is it's partially true and partially false.
Please elaborate.
Please elaborate. The truth of the matter is that most municipal bonds are exempt from taxes at the federal level. So if you don't live in the state, but you buy the municipal bond, you don't owe any taxes on the federal level. However, you do owe taxes on the state level. So if you answered true, you're probably right. And if you answered false, you're probably right on this one.
But if I live in California and I buy a bond, in a municipal bond in Florida, okay, so that's going to be tax-free federally, but I have to pay California state tax on it?
Yeah, no, 100%. And why might you want to do that? You might do that if that bond in Florida pays you more interest than the bond you would get in California. So when you're buying a municipal bond, what you want to do is compare your after-tax return to what you would get versus another bond. And so if after paying taxes to Florida, you still wind up with more money in your pocket than on a potential California bond, it may make sense to buy the Florida bond. You also might just do it to diversify, right? Because if you live in California and all the bonds you buy are in California, you're very exposed to the local economy. If you buy some bonds in Florida, you're spreading out that risk a little bit.
Yeah, but if I just buy bonds in California, it's tax-free state and federal.
Correct, yeah. But if something happens at the state level, whether that's a financial thing, like let's say Sacramento runs into trouble, or whether it's just a regional disaster, you could have some exposure there. So it depends really, again, on what you're doing in your overall portfolio and on what role the municipal bonds are playing. But for people that have very large exposure to municipal bonds, sometimes it makes sense to step out of state and buy a few bonds in other areas.
All right, let's kind of break some other things down here. We're looking at why invest in bonds, right? Almost zero interest. You know, we hear this quite a bit. It's like, this is a guarantee to lose money, right? Because interesting enough, as interest rates go up, your bond price will fall. It's kind of a weird, dynamic there. So as interest rates go up, the face value of the bond goes down. So we're in a really low interest rate environment, and if I were to pull all of you out there and say, where do you think interest rates are going to go? I would probably guess 90% of you would say, well, they have to go up at some point. Well, as interest rates go up, the bond price falls. As long as you hold that bond to maturity, you're going to get your face value back. But the problem is that why would you want to continue to hold this bond that's only paying you 1% while now the market is paying 4%? So you will receive a discount if you sell that bond early. That's why people are like, get me out of here. I don't want anything to do with this crazy investment. So Brian, let's break this down. Number one, potential diversification benefits. I just said it's the worst investment ever. Talk me into why I should invest them.
Yeah, well, part of investing is that when you build a portfolio, you want some things that are going to zig when something else zags. And the reality is that a lot of the time when the stock market's going like this, bonds may kind of muddle along. But by the same token, when the stock market's going down, which you all remember March of 2020, bonds tend to hold their value better, maybe even go up. And so that's the whole nature of diversification. It's not that everything's doing great all the time. It's that some things are performing differently and the whole becomes greater than the sum of its parts.
So when you're looking at diversification, it's like, all right, I think we have recency bias a little bit. It's like, well, the stock market is doing so well and the bond market is just doing terrible. Why do I want any bonds whatsoever? Remember, this is your safety net. All bonds not created equal. We talked a little bit about this, but let's share a little bit more. In this type of environment, with interest rates as low as they are, as we can see them go up, where should people look to invest? Long, short, corporate, municipal?
Yeah, and of course it always is going to depend a little bit on people's situation, but the longer the bond, the more risky it is if interest rates go up. And so if you play out the scenario in which interest rates are low and they head higher, the natural conclusion is you want relatively short-term bonds, particularly because you're not getting a lot of extra income for going out longer. So a lot of people should look at, all right, how much can I get for, I don't know, a 5-year bond or a 10-year bond as opposed to a 30-year bond? It might make more sense to stay a little bit shorter in a low interest rate environment. It might also make sense to own different kinds of bonds. So maybe own some corporate bonds. They tend to get a little more return than a treasury bond would.
The advantages, which we've talked about, is going to be a buffer, right? So as the market kind of goes zigs and zags and goes up and goes down, your bond portfolio should be there really to create that safety net, right? Some people look at buying bonds to create income, right? But when you look at interest rates today, you have to take on quite a bit of risk in some cases to get the income that maybe would be sustainable.
Although you're not getting all the income you want, you're still getting more income than you would sitting in cash, right? So at least you're hopefully keeping pace with inflation and not losing purchasing power like you would if the money was just under the mattress. The other thing is you're still getting those diversification benefits from bonds, and you're getting safety, right? Again, a bad year in the bond market is really different than a bad year in the stock market. And I think that's important to remember. Like you said, Joe, we're so used to seeing stocks go up given the last decade. But remember what happened March of 2020. Remember what happened back in 2008, those sharp collapses in stocks. You see, bonds have never really fallen that way. High quality, short-term bonds, a really bad year historically has been 2 or 3% to the downside.
Disadvantages of bonds, and we've talked about this, is that as interest rates go up, bond prices go down. And so you can absolutely lose money in a bond. It's not necessarily always the safest investment, just depending on the type of bond that you own. Again, like a simple example is that I'm going to lend Brian $100,000, and I'm going to charge him $5,000, or 5%, for that $100,000. Okay, and all of a sudden, as interest rates go up to, let's say, 7%, okay, well, Brian's paying 5%, right? So he's got a pretty good deal. Or he's paying me 5% versus the market now is paying 7%. If I go back to Brian and say, hey, can I get that money back? He's going to say, well, no, because I still need the use of the capital. And if I have to borrow it again, I have to pay a lot higher price for it. So you just want to make sure that you understand like kind of the dynamics of the overall instrument, because it gets a little complicated.
Yeah, I mean, it's interesting because people don't understand bonds as well. The reality is they're really complicated. There's only one stock for every company for the most part, right? GE has a stock or IBM has a stock, but those same companies might have hundreds or even thousands of bond issues. And so it's really important as you look at this to figure out how are you going to invest in bonds, right? It's not as easy as just saying, hey, I want IBM. You then need to decide which IBM bond you want if you're going to go out and do it yourself. You need to figure out how to buy it because they don't trade like stocks where you just go out and you know what the price is and you buy. They trade more like real estate where you have to figure out who's going to sell it to you and you have to come up with a fair price on your own. And if you're not an expert, that price may or may not be fair. And then you need to track it on an ongoing basis. So buying bonds is really complicated compared to stocks. And that's why a lot of people wind up going the mutual fund or exchange traded fund route.
All right, we got to take a short break. Why buy bonds in a zero-rate environment? I don't know. Have we convinced you yet? Who knows? Go to our website, yourmoneyyourwealth.com. Click on our special offer. It's our bond guide for this week. You can learn all about the pros and cons. Hey, when we get back, we're going to talk about alternatives. If you don't want to buy a bond, can I get something else? The answer is yes. And now I sound like a bond salesman. That was Brian back in the day. We got to take a break. Show's called Your Money, Your Wealth. Hey, welcome back. Hopefully you're back. We're talking all about bonds today. Why should you own bonds? We're trying to educate you on the instrument to see if it makes sense in your overall investment strategy. Before we get into alternatives, let's see how you did on the true-false question.
Yeah, and so in a zero-rate market, you should only invest in bonds with a short maturity date. I'm going to go with a false on that. And my reason for going false is that I think a lot of the bonds you own should be reasonably short, but you probably want to blend in some longer-term bonds as well, because we talked earlier that interest rates they're guaranteed to go higher. That's not always necessarily the case. If you look over the last decade or so, rates have been pretty low and a lot of people have been waiting for them to go higher. Hasn't happened yet. And so owning a couple of longer term bonds gives you a little bit of protection against that. So my answer is false. What about you, Joe?
False. It's a good, right? Because we don't know what's going to happen to interest rates. I think you're right. We've talked about that. It's like, well, interest rates have to go up, right? And as interest rates go up again, your bond price falls. So it's like, well, if I'm in a low interest rate environment, we got to keep that maturity short. So my risk is very limited because the longer you go out, think of a teeter-totter, right? The longer you go out, you're going to see kind of that decrease or your discount or premium kind of go higher or lower, depending on the maturity or the duration of the overall bond. I agree with you, though. You're the bond expert, so I think you're right. Because if you followed my advice and say just stay short, you probably would have lost some money. Because over the last decade, longer-term bonds have performed quite well.
Yeah, and and it's balanced. And when we say longer term, we don't mean that all of your bonds should be longer term. It's just blending it out as opposed to staying. I think some people hear short-term bonds and they go out and they buy a bunch of one-year bonds or something and their yield is effectively 0, right, or 0.5%, as opposed to buying some of those and then maybe some 3- and 4-year bonds and then maybe sprinkling in as appropriate some 10- and 20-year bonds, and you wind up with a blended average that's still reasonably short but gets you a little bit more return and also a little bit more of a hedge too, because if you think about that idea that in some scenarios when stocks fall sharply, the bonds go up, well, the longer maturity bond in that scenario generally goes up more than the shorter maturity, so it gives you even more protection in a volatile stock market.
Can you tell he's pretty passionate about bonds? Let's kind of switch gears. Increased exposure to real estate. Let's say you don't want to get into a bond. All right, well, maybe you buy real estate. Real estate, right, you can purchase a home and you get rents. It works similar High quality, intermediate term bonds. So now I'm going not short, but hey, I want to go high quality. But what is a tip and what is a preferred?
Yeah, and hopefully my passion will come through again, right? I'm feeling like not James Bond, but a bond geek here a little bit. But, you know, a tip is simply, it stands for Treasury Inflation Protected Securities. What those are is those are bonds issued by the U.S. government, so they're still really safe. Except that they have an inflation adjustment component so that if inflation goes higher, which like we've seen recently, the value of that bond resets. So they give you a little bit of protection against inflation. Could make some sense in a potential environment where we are seeing prices go higher. Preferred securities are a hybrid asset class. You've got stocks like we talked about. You've got bonds. Preferreds are in the middle. They're another way for companies to raise capital, but it's a little bit more of a niche market. The reason some people like them is they provide higher returns. We talked about treasuries at 1.5%. I don't know, you might be able to get 3 times that. You might be able to get 4 or 5% from a preferred right now. The issue, of course, is that preferreds are a good deal riskier than an ordinary corporate bond would be.
Let's switch gears a little bit. Let's go to Ask the Experts.
So, coming in from Bill in Alpine, since interest rates are low and there is a housing shortage in our area, is it better to invest our money in rental properties? The answer, just like whether or not you should invest in bonds, is probably it depends, right, Joe?
You know, a lot of people love to purchase rentals, right? Because stocks is an unknown, all right? It's in a brokerage account, I see it go down, but you know what? I can drive by my house and I can see my rental property, right? And some people have a lot of comfort with that. But you have to look at a couple of things. Is that what's the market value of the home that you're purchasing versus the rents that you're receiving? Then you can look at that and say, okay, well, what's my cash on cash return? In Southern California, where we're filming this, you know, the cash on cash is quite low just because the property values in Southern California are a little bit higher than other areas of the country. So if you go to Minnesota, where I'm from, the market value of homes are a little bit lower, but the rents are relatively the same. So you could probably get a higher cash on cash return in other areas of the country versus just looking in your backyard. So there's a lot of different things that you want to consider with rental properties. I think they're a phenomenal asset class, but there's also a ton of work involved there.
Kimberly's asking that I'm afraid stock prices are artificially high because people are putting their money in stocks rather than bonds. So does that make it a good time to convert stocks to other investments like gold or annuities? I think that's really an apples and oranges thing, where gold and annuities are both very different investments from each other, as well as very different from stocks. Joe?
Yeah. No, you're timing the market. You're trying to get into alternatives. I think you need to look at what your portfolio needs to be right now. And if you're thinking, oh, stocks are high, let me sell, or stocks are low, let me buy, you have to have a systematic way to do that, and that is called rebalancing. I think a lot of us get emotional when we look at our overall portfolio, when we read or hear the headlines that stocks are at all-time highs. Oh, maybe it's time for me to sell out and buy gold. I would be very, very careful with that strategy. So, what did we learn today? Well, bonds are boring, is what we learned, and hopefully that's perfect, because bonds should be boring. They are there to protect you when the overall market is very exciting, right? So you need a little bit of diversification in your overall strategy. And we also learned why invest in bonds. You know, we're looking at the risk and return of different offerings that bonds have. And then we also talked about alternative investment sources. So go to our website, folks. Why invest bond in a zero interest rate environment? We'll get our special offer today. It's at yourmoneyyourwealth.com. Click on the special offer. We're giving you the news to make proper investment moves. All right, I want to thank Brian Perry. He's our EVP, Director of Research. He's a bond man. Brian, and I'm Joe Anderson. We'll be back next week, of course, with Big Al back from vacation. Hopefully you enjoyed the show. We'll see you next week, folks.